NACDL's White Collar Summer Series event, an overview of federal criminal tax. This program will address the unique DOJ practices and procedures that govern federal criminal tax matters, the primary statutes utilized by the government, and defense considerations and strategies. And if this kind of topic appeals to you, may I recommend that you consider attending our 11th annual White Collar Seminar that will be held October 21st through 23rd in New York City. We will be covering topics as diverse as defending economic espionage and computer crime cases, defending export controls and economic sanctions cases, forfeiture issues, money laundering, healthcare fraud, and much, much more. Today we have the fortune of having Tom Zehnle walk us through an overview of federal criminal tax issues. Tom is a partner at Miller & Chevalier in Washington, D.C., with more than 25 years of experience in tax, white-collar, and civil litigation. He brings a broad perspective to handling such matters, having served as a defense lawyer, a federal prosecutor, and as the chief of the U.S. Department of Justice Criminal Enforcement Section, supervising fraud prosecutions across the country. He maintains a diverse practice representing corporations, partnerships, accounting firms, and individuals who have been indicted or who are involved in grand jury investigations, federal regulatory actions, and civil disputes. He has the distinction of that rarity of rarities. He has taken cases to trial, and he has won. While his many accolades and professional recognitions are numerous, what's even more impressive is that he manages to make tax defense CLEs exciting, even dare I say fun. So I don't want to stand in the way of getting started except for one last announcement. We have a very large online audience today. We will leave some time at the end for questions. To submit a question to us, please email me personally at sotoole@nacdl.org, and we will try to get Tom to answer them at the end. My email address, along with the CLE code for today's program, will continuously appear at the bottom of your screen throughout the program, so don't panic if you didn't write my email address down. And so we begin.
Thank you, Shanna. I appreciate that. Let me begin with just a couple housekeeping matters. First of all, while I have prepared some materials which you should have access to, the overview of federal criminal tax, the PowerPoint presentation, I'm not going to follow that and just simply read page after page of what's been written. I will be jumping around a bit, adding in things that I've learned based on my experience, and when I do refer back to it, I'll let you know, hopefully, page number, just so you can refer back to it for those online and for those here in the live audience. So there's an old adage that nothing in life is certain but death and taxes. And since I do not handle homicide cases, we are going to be talking about tax cases today. And in particular, we're going to be talking about criminal tax cases. Now, the reason that we are going to focus on federal criminal tax is that for the most part, the state departments of revenue don't regularly enforce in a criminal matter their tax laws. Usually, if there is some state enforcement of criminal tax matters, it's usually an add-on to what the IRS or the service has been doing. So if it's a criminal tax matter, federal is basically the ball game. That's where you're at. I'm here to tell you that in terms of white-collar practice, white-collar criminal defense practice, tax is different. I'm sure a number of you are online and in this room because you understand that there's something a little bit different about it. Well, what is different about it? If you think about it, tax laws apply to literally hundreds of millions of persons and entities in this country, and not even in this country, because non-citizens and non-residents can actually have tax issues arise. So the tax law's broad reach is really what makes this area different than many other areas of white-collar criminal practice. Because it impacts so many people, and I'm talking about individuals, corporations, partnerships, even an executor for a will, things like that. because it impacts so many people, the Department of Justice has determined, and Congress obviously, that you need a uniform and even-handed application of those laws. So for example, we're sitting here in Washington, D.C., and I think it's fairly obvious that in terms of the application of federal criminal tax laws, you wouldn't want a situation where someone across the river in Virginia commits, say, a tax evasion offense and ultimately is, say, given probation. Basically, the U.S. Attorney's Office takes it easy and says, we're not going to really push that. We've got other issues that we have to deal with here. Whereas on the other side, say in Maryland or in the district itself, you might have U.S. attorneys, assistant U.S. attorneys, who say, no, we take this very seriously, and we're going to throw the book at you. So in order to avoid an uneven application of those laws, what has been done is that the jurisdiction and the authority over tax matters has been centralized in Washington, D.C., with the U.S. Department of Justice Tax Division. So, unlike other white-collar criminal cases, the vast majority of them, before an assistant U.S. attorney can bring a case, a tax case, they have to get approval from Main Justice in Washington, D.C. That's both for investigations, if you're going to open up a criminal tax investigation, and it's also for authorization to prosecute a case. That is, actually seek the return of indictment and bring the case in your district. There are very few areas of federal criminal law where you essentially need the explicit approval in Washington before you can bring the case, if you're an assistant U.S. attorney. I know that under, one area might be RICO. Is the only one that really jumps to mind. But for one that applies on a very broad basis, it really is criminal tax matters. So, let's talk a little bit about who can be held liable. Well, as I mentioned before, it's essentially any taxpayer, whether it's an individual, a corporation, a partnership, a partner in a partnership, an executor, anyone like that. It can be the entity, and it could be the individual. Now, recently, I'll just note as an aside, the Department of Justice came out with a new memo with respect to the prosecution of individuals and corporations, and how there's going to be more of a focus on actually looking at executives within corporations for prosecution. Since this is what I view this as mainly a criminal tax primer, if you will, criminal tax 101, we're not going to get into a lot of the nuance there, because I think we have a lot of audience members who are just trying to get a basic sense of what are the statutes, how's the process work. But those are things maybe we'll have, depending on how this one goes, maybe we'll have a 201 or a 301 series for those who are really interested in kind of delving into some of the more nuanced topics. So basically, everybody, most of the people that you know, are going to be covered by the tax laws, your clients. And therefore, if there is a potential violation of those tax laws, they are going to be subject to the process that I'm going to get into. Now, of course, they have to have income. That's a basic, right? And what is income? I promise not to sit there and talk about a lot of code sections and statutes and things like that. But if you look in the Internal Revenue Code, which is Title 26 of the United States Code, gross income under Section 61, if you ever have the interest, take a look at it. It basically includes just about everything, other than loans and gifts that someone receives, etc. But the income, it's about everything you can think of: wages, dividends, interest, what have you. And the only point I want to make here for a number of the audience members. It's not just legal source. Illegal source income needs to be reported. Now, we all understand that people who have potentially made money, through various means of fraud, narcotics trafficking, whatever, they're not going to be reporting it. But the fact of the matter is that income under the law is supposed to be reported. So, keep in mind, your clients, they have income, they're going to be covered by the tax laws. Now, as I said a moment ago, who's responsible for overseeing what we call the Federal Tax Enforcement Program? Again, that's DOJ tax. And their authority, for those of you who are interested, again, I'm not going to give you too many sites, but that's under 28 CFR 0.70. And that's what grants exclusive authority to approve tax investigations and tax prosecutions to DOJ tax. Why is that important? Well, because of what I've just been talking about, that opens up certain avenues of defense for practitioners like us. You see, it's not a typical case of, a fraud case, receipt of a bribe or some kind of potential securities fraud or something like that. The assistant U.S. attorneys in those cases don't have to worry about coming to Washington and saying, Mother, may I? They don't have to ask permission. In tax cases, they generally do, unless the tax division at the U.S. Department of Justice has specifically delegated the authority in certain limited instances to the U.S. attorney's offices. They generally do have to come to Washington and ask permission, either to initiate that grand jury investigation or to seek the return of an indictment. So unlike what I said is, say, a more common type of fraud, for the defense lawyer, it allows us another chance to go and talk with people in the line of command that may or may not be able to essentially kill that indictment, kill that investigation. So keep that in mind, and we'll talk about the procedure by which you request that conference with DOJ. But keep that in mind, because in a lot of the areas that many of you are dealing in, you don't really have that option. If you run into a stone wall with the prosecutor that you're dealing with in the local U.S. Attorney's office, you're kind of stuck. Another thing, as we talk about tax cases in general, it does tend to be a little more nuanced and a little more complicated. There are accounting principles and tax principles that are involved in a number of these offenses, which, if you don't have a financial background, might seem a little foreign at times. Doesn't mean that people can't learn these things. They obviously can. But it does make it a little trickier. And the more you know about accounting, tax principles, etc., the more possibilities you have for raising technical defenses when you ultimately meet with these DOJ attorneys in Washington. So let's talk about the players that you're going to be dealing with. It's almost like an episode of Law and Order, right? You have the police and you have the district attorneys. In this case, the police is the Internal Revenue Service Criminal Investigation Division, or CI. These special agents, and I do say special agents because they are law enforcement agents with the ability to arrest, etc., are the police for criminal tax matters. The quote-unquote district attorneys would be either the tax division prosecutors, who may be handling the case, or the local assistant U.S. attorneys who are handling the case, or it could be a combination of both. because oftentimes the local U.S. attorneys may not feel comfortable handling a particular criminal tax investigation or a criminal tax prosecution because of some of the reasons that we just discussed. The federal prosecutors at the U.S. Department Tax Division handle these cases day in, day out. And they thus have an ability to gain a lot of experience in the technical issues that arise in these cases, and they know how to handle them. So from a defense perspective, you have to kind of keep in mind, as you always do, who's the opponent in this particular matter. Is it someone who's done these cases before? Is it someone who hasn't done these cases before, but they're having assistance from a DOJ prosecutor? Or is it a couple of DOJ prosecutors involved? So let's talk about CI just for a moment. With respect to IRS CI, as I said, they're special agents. And one thing to keep in mind as you run across tax issues in your practice, if your client comes to you and there is a revenue agent involved, revenue agents are generally civil tax agents. They are not authorized, and they are not criminal investigators. So keep in mind, first of all, if you get a phone call and someone says the IRS just came by and wanted to talk to me, I mean, one of the first things you kind of need to do is say, well, was it a revenue agent or was it a special agent? Did you get a card? So keep that in mind, because special agents obviously connote a much more serious situation for your client. They're excellent financial investigators in my experience. And again, as Shanna started off the discussion, I've done this on both sides, probably a little more on the defense side, but I spent a lot of time on both sides, and I can tell you, working with them on the prosecution side and working against them on the defense side, they're generally very good at what they do. I mean, they often are talked about as being the best financial investigators that the U.S. government has. So keep that in mind. In fact, and we might touch on this in a moment, I'm sure, almost everyone here has heard of Al Capone, right? Al Capone was brought down, as many of you know, on tax charges. And those tax charges were developed by the precursor of the modern day IRS CI special agent. They came up with a way of essentially proving a crime against Capone when they couldn't prove the substantive crimes that he was being accused of committing. So, and they came up with it in a very clever way, and I think I might mention that if I don't, remind me during the tax evasion discussion, because the method by which they ultimately identified his failure to report his income was rather clever and new at the time. It's now used much more often in terms of criminal tax investigations. It's an indirect method of proof. Now, one other thing about the special agents before I move on. When they do show up, and I've told you that it's a very serious matter, since this is more of a primer course, one of the first things that when I got involved, when anyone gets involved in a tax case is, well, can't I just pay the tax and kind of get this behind me kind of thing? Don't do that. It's going to tell the prosecutor that you really don't understand this area of practice. Special agents don't care. Realistically, they don't care about getting the tax money paid back. They care about it in terms of how it fits within the U.S. sentencing guidelines and what kind of incarceration term your client might get, because that creates deterrence when people go to jail for these things. But they're not that interested, generally speaking, I'm sure there's always an exception, in what the tax, what taxes you owe, or can't you just pay a penalty in the taxes and some interest on it? That's civil. So keep in mind, you're not dealing in that realm. And don't get confused early on if a special agent comes up and think, hey, can't we just pay this and get out of this thing? Now, the prosecutors, as I said before, generally speaking, local AUSAs or tax division prosecutors at Main Justice. Who you get is quite dependent upon, what district you're in. For example, Los Angeles has its own tax division within the U.S. Attorney's Office, which handles both civil and criminal tax matters. Of course, they still have to go through the process of getting things approved in Washington, but they have people that are dedicated to it. New York, SDNY, I believe, also has the same, and EDNY, I believe, has the same. But most districts don't have like their own tax prosecutors. And that's important for the reason that I mentioned earlier. They may not have a good grasp of the charges that are being referred to them by the IRS. And so they might need assistance from either DOJ prosecutors in Washington, or they're going to have the agent educate them. But just note that some offices are familiar because they're big enough that they see enough tax cases, over the years, during the course of a year and over the years, that they actually gain experience in this area. So keep that in mind. But other districts in the country might very well need someone with that specialized expertise. Now, another reason that you might find a Main Justice prosecutor handling the case as opposed to an AUSA is that in some of the smaller districts, they just don't have the resources to handle what could be a lengthy white-collar case, albeit specific to tax, but it's a lengthy case, paper-intensive, accounting, tax concepts. They might not have the resources, even if they have someone who's done them before. They might be stretched thin. So that's a reason that you might find tax division prosecutors handling it. And again, because that's all they work on throughout the entire U.S., regardless of district, they have developed expertise in the technical issues that come up and some of the recurring problems that you find in a criminal tax case. So let's at least start talking about some of the basics that you guys need to know. What are the offenses under the tax code that generally are charged by the U.S. government? And if we'll go to, I believe it is page 4 of the PowerPoint presentation. That starts off with the federal tax offenses generally. So tax evasion, which is found under 26 U.S.C. section 7201. That's an attempt to evade or defeat taxes. And the elements are, there's an attempt, there's additional tax owed by the taxpayer / defendant, and there's willfulness, which in tax cases is defined under Cheek v. United States, the citation of which I have put in the materials. So, again, that's page 4 of the materials. So let's talk about those, because tax evasion is the single most important tax charge in the federal prosecutor's arsenal. An attempt. There has to be some kind of affirmative action by the taxpayer defendant to evade his tax obligations, either the assessment of those obligations or the payment of the tax that's already been assessed. So we'll talk about it in just a moment when we get to section 7203, which is a willful failure to file a return, which is a misdemeanor. Now, years and years ago, when I first started doing this, I thought, hey, if you don't file a tax return, that's tax evasion. But they educated me over at the DOJ when I got there, and basically explained that the failure to file offense, which we'll talk about in a moment, is not one where you have an affirmative act. You're simply not doing something that you are required to do. It's an omission as opposed to a commission. So tax evasion involves an affirmative act. One of the things that I deal with quite regularly over the last number of years, and some of you I'm sure have come up with, the taxpayer hiding funds in a secret account overseas. That would be, for example, an affirmative act of evasion. The government, there's probably as many affirmative acts as you can, as the mind can think of. The government will assert that, an extensive use of cash, that is, to not create a paper record, could be an affirmative act of evasion. The second element is the additional tax due and owed, or what we call the tax deficiency. Now, this is where it gets a little bit more technical, because what the government has to prove in the tax evasion felony is that the taxpayer actually owes money to the government. As we'll see in a moment, that's not always the case in the charges that they can bring. But here, they have to. And so in terms of computing that tax deficiency, you're going to have an opportunity to attack technical aspects of how that deficiency was determined. Now, they can do this in multiple ways in terms of their proof, that is the U.S. government's proof. For example, a simple example. If someone received a $100,000 check from an individual, and let's say they deposited in that foreign bank account that I just mentioned, and it never shows up on the return. Well, by direct evidence, if the government's able to obtain that check, that's direct evidence that there was money received, it's over the threshold amount which you would be required to file a tax return, and it doesn't show up on the tax return. Now, of course, they'd have to show the third element, which is willfulness, and we'll talk about that. But that's a very straightforward example of how the government might prove gross income received by your client, the taxpayer defendant, that didn't show up on the tax return. Of course, the returns would have to be put into evidence as well, which they always are. Now, I said a moment ago I just was going to spend a minute or two on the Al Capone case, because it's interesting. With respect to Al Capone, the government couldn't make the racketeering charges that they believed Mr. Capone was engaged in, and which we all ultimately know that he was. But what they did was say, well, gosh, he's got a whole lot of assets all over the place. And when we look at his tax returns, we don't see anywhere near that amount of income being shown up. Now, he's not getting checks like in my former example. It'd be too easy, right? I mean, he's a mobster. He's racketeering, and a lot of the income he's getting is in cash and off the books, and there's not going to be that direct evidence unless you're able to actually get the books and records that he's keeping under the table. So what the special agent in that case did, the special agents, was essentially take a look and document his net worth, things that he owned. And they would do it, and you have to do it for each specific year, because every year you have an obligation to file a tax return, assuming you've met the minimum threshold, and we're going to assume all our clients are meeting that threshold. Government's not going to waste its time on a small dollar case. But they went and they gathered the records and established that in each of those years, his net worth, the assets that he was purchasing, etc., were way above what could be sustained by what's being reported on his tax returns. And that became known as the net worth method of proof. It's an indirect method there are a lot of technical aspects that the government must show in order to use that method in a tax evasion case. So we're not going to delve into that here because we just simply won't have time. Maybe another time we can get into that. But that is one way that the government will attempt to show income that's not being reported. Now, there are a couple other indirect methods. Again, we're not going to get into them, but there's another one known as the bank deposits method. And so if your client, let's say, has a regular, I don't want to say, whether it's a mom and pop store or just a regular business, and they make regular and periodic deposits into their bank accounts. Oftentimes what the government will do in those cases, if they don't have direct evidence of evasion, is they'll simply go subpoena, or summons those records. And then, again, similar to the net worth method, we'll look at, well, wait a second, those bank deposits show that this person deposited $750,000 this month, $500,000 this month, and they'll just add it up and say, well, does this mesh? Does this reconcile with what we're seeing on the tax returns? That's shorthand, that's the bank deposits method. Now, there's one other method, and I'll just throw it out just so that you're aware of it, called the expenditures method. And that method is used where you don't have like regular and periodic deposits to a bank account, or you don't have someone who is acquiring, large assets like a mansion or, the boats or the fancy cars. But they're evading their taxes by essentially going out and living the high life. So in those instances, the service and the prosecutors are required to show, the person's going to Vegas all the time, and spending $100,000 at the tables. Now, they may lose that $100,000. But the point is, where did that money come from for the person to be able to go out and make those expenditures in the first place? Because at the end of the day, that person's not going to have an asset that the government can track down. And he's not putting the money into a bank account. He or she's not putting it into a bank account. So they focus on trying to establish through evidence these expenditures, that the person's essentially living the high life and not paying their tax obligations. So those are three primary indirect methods that the government uses to establish tax deficiencies, which is a key element, as I said, in a tax evasion case. And then the final element, which is important, and this is something that everyone should remember, is willfulness. Criminal tax cases have the highest level of intent requirement. It is a voluntary, intentional violation of a known legal duty. You have to know what you're doing. You have to intend to do it. You're doing it voluntarily. No one's putting a gun to your head. And you know it's against the law. That is a high standard of intent, and it's required in all criminal tax cases, and generally in cases where the regulatory regime, the laws are very technical and nuanced. The courts will require that kind of intent, because otherwise, as everyone sitting around this table and on site knows, it's complicated. I mean, there's a reason that there are these tax preparation businesses that make hundreds of millions of dollars during the filing season. It's complicated, and the government understands that, and there's always the possibility of just negligence or mistake, that the person didn't understand, oh, I was supposed to report this particular item. So, when the government brings these cases, they have to show an attempt to evade, they have to show that there's a tax deficiency, and they have to show willfulness on the part of the taxpayer in order to make the evasion case. This is the primary statute by which they operate. And as you can tell, it's got the highest penalty, 5 years, and the fines, and it is a 6-year felony, a 6-year statute of limitations, a 5-year felony. And most tax cases you will find that are felonies have 6 years as the statute of limitations. The misdemeanors are 3 years. But that gives the government an ability to go back a significant amount of time in order to prove its case. So, one last thing I put on there, and I will talk about it. Remember, tax evasion and tax avoidance are two different things. It's okay to manage your affairs so that you don't have to pay the maximum amount of tax. But what the government is saying and what the law says, if you're doing it in a manner that you're attempting to evade obligations that you clearly know you have, that is the crime. So the avoidance versus evasion sometimes comes up, but it's important to keep that distinction in mind. So going to the next one, some of these I'm going to go through a little more quickly just because I know our time, but I want to get through these because you may see these kind of cases come up in your practice. Willful failure to collect or pay a tax under Section 7202. Think of this as the employment, the FICA tax, and Medicare taxes. What happens sometimes, and some of you may come across clients where they've essentially failed to either collect or more likely report taxes that they're collecting on behalf of their employees. As most W-2 wage earners, at some point in your life, you probably know that, the employer puts in some and you put in some. And that's the way essentially FICA works. Oftentimes in smaller businesses, you might have a client who, for whatever reason, decides to basically hold on to that money that they are collecting from their employees, but not pay it over to the IRS. That's an employment tax fraud. It's also a significant felony under the Internal Revenue Code. It's a 5-year felony. As I've indicated, again, it's a 6-year statute of limitations. One thing recently, just again, to kind of pique your interest, the government has recently been saying, in response to many defense arguments in these cases, look, the only reason my client kept that money and didn't pay it over to the Internal Revenue Service is because the business was having trouble and they were trying to keep the business afloat. They've reiterated once again that defense is not going to fly. Now, if you're in a trial, and this is way above what we're going to be talking about today, there might be ways that you can use that information in terms of persuading a jury that your client shouldn't be convicted of the crime. But technically, they're not going to sit there and say to you early on, hey, we understand. And in truth, most of the time that you see these situations, there's always going to be some problem with the client went out and bought something that maybe could be characterized as more personal, I'm just not putting the money back in. And so the argument on its facts might fall apart. The next charge that we want to talk about is the failure to file a return. And I mentioned that just a moment ago. This is a misdemeanor. This is essentially an act of omission. You have a duty to file tax returns. In the situation we're talking about where a 7203 charge is brought, you have enough income that would require you to do it, but you just don't do it. Now, there might be reasons why the individual doesn't file it. Sometimes, and we probably don't deal with this in the white-collar practice that much, but you will hear so-called tax protesters saying, I don't think I owe it, I'm just not going to do it. They'll have other arguments why it wasn't willful, but the point is, it's an act of omission. And the service will sometimes raise this charge where it's clear-cut and maybe where the evidence of an affirmative act of evasion isn't as strong as the government wants it to be. As a matter of fact, I think this is I'm actually fairly confident this is the charge that the actor Wesley Snipes was convicted of a few years ago. And I do remember the headlines at that time essentially, he just got convicted of a misdemeanor, it's not a big deal. But for any of you who've been practicing who have a federal practice, you understand that these things can be stacked, and that's what happened, and that's why he ended up getting a fairly significant jail sentence in that case, because the dollar amounts were very high under the U.S. sentencing guidelines, and they simply stacked the misdemeanors. As I said a moment ago, each tax year stands on itself. So every year you don't file it, you get another potential 1-year sentence under the statute. So that's what they did. If your facts warrant it, something to maybe explore if you're in negotiations, if you're looking to resolve the situation. But I will tell you, the government's preference and its focus and its goal, objective, and policy is to always charge the most serious violation that they believe they can prove, so that if you have a failure to file a return and you add an additional fact onto it, an affirmative act, they will turn that into what's known as a SPIES evasion. SPIES is the name of the case. So essentially you take someone's failure to file, but guess what? They were doing something else on the side that also helped conceal their actions, and that therefore it's no longer an act of omission, it's an act of commission, and then they'll charge you with the 5-year felony under 7201. There's also failure to file information returns, 6050I, trader business, when you receive more than $10,000 in cash in a trader business, tend to have a more significant penalty now that it's been amended. But that is less used. So then we go to the next one, which is 7206. This is what is known as the false or fraudulent statement section. Now there's multiple subsections under it, but what it really is that a material matter on the tax return is false. The taxpayer signs it under penalties of perjury, which we all do. If you've ever looked at at the jurat above your signature line, and there is willfulness, that you know that you're signing a return that's not accurate. So why are we talking about this one? If the government has problems establishing the tax deficiency, which we just spent some time talking about, if there are technical issues that come up that we as defense lawyers are able to raise and say, I'm not sure you can prove that he actually owed that amount of money, there's some question as to the way you computed or ascertained the tax that person owes, they may take the tack of using section 7206(1), parent 1, close parent. Failure to file, filing a false and fraudulent tax return. And they could look simply at the gross income number. Not to get into the specifics too much, but if you think back to your own 1040s, you go through the process of identifying all your sources of income, wages, dividends, interests, etc., capital gain, all that kind of stuff. And then you come up with a total income line, and then there are certain adjustments that you're allowed for, and then obviously there are additional deductions that you're allowed for. Then you ultimately arrive on the page 2 of that 1040, if you all remember it, with your taxable income. So if the government's having problems figuring out, okay, what is your true taxable income for this particular taxpayer, they may say, well, what you did is you didn't put all your gross income on the appropriate line, which is usually line 21, 22 of Form 1040. And that would be a false and fraudulent statement made under penalties of perjury, and assuming they have the evidence, willfulness, that you left off income that you should have put on there. So they might use that if they have problems showing up a technical tax deficiency. It's a 3-year felony, but it's used fairly often. And if it's any material matter, they can use this statute. Just one example. If you're a narcotics trafficker, and let's say you're going to put all your income on the return because you don't want to mess with the Internal Revenue Service. You're worried, they're good financial investigators, you're concerned about it. But you put it down as well, I'm on the gross income line, well, I operate car washes or something like that. That is a materially false statement. So even though you've reported it, even if you go through the whole process and report all your income and all your taxes, if you're a narcotics trafficker, but you misidentify the source, that has been held to be a material fraudulent statement, and you can be prosecuted for it. Now, presumably the reason would be that the IRS would have a very difficult time properly auditing a tax return if you're misidentifying sources of income or things like that. But regardless, the case law clearly holds that that is the case. So the next statute, 7207, I'm not going to spend really much time talking about this simply because it almost appears to be a misdemeanor 72061 charge that I just spoke about. But the government rarely allows this. And they have internal policies that essentially say we don't let people try to negotiate a resolution of the case by pleading to a 7207 charge. I put it out there because it always looks good, but the government always pushes back very hard, and it's very difficult in terms of trying to resolve a case if that is your strategy to use that. 7212, parent A, closed parent. This is called the omnibus clause. It essentially is tax obstruction. That's the way I shorthand it. And the government will use this in cases where they think the taxpayer defendant is interfering with the due administration of the Internal Revenue laws. It's very broad, but the way you should probably look at it as though it is essentially obstructing the Internal Revenue Service in its functions, whether it's audit or investigation or what have you. They tend to use it more frequently than you would imagine. Not as much as 7201, but it is being used more frequently by the tax division prosecutors and by assistant U.S. attorneys. It's a 3-year felony. Again, there was, at one point there was an argument about the statute of limitations, but I think it's fairly well settled in the case law that it's a 6-year statute of limitations. Client conspiracy. Now, probably many of the people in our audience are very familiar with the general conspiracy statute under Title 18. Focusing on tax in specific. This is a conspiracy to defraud the government by impeding and impairing the Internal Revenue Service in its lawful functions. Well, what are its lawful functions? Ascertaining, computing, assessing, and collecting federal taxes. So it's not different in the sense of the elements of any conspiracy. There has to be an agreement between two or more people, as we know. But the focus of the client conspiracy is on what we call the second prong of Section 371. You can agree to commit a particular crime, or you can agree to commit a fraud. And so the client conspiracy is essentially under the fraud prong, and it relates to impeding the IRS in ascertaining, computing, and collecting taxes. Government uses this a lot. As we all know, conspiracy charges tend to be the prosecutor's darling because it opens up many avenues, many strategic avenues for them, co-conspirator statements, all kinds of things. This one's used fairly regularly, like 7201 in criminal tax cases. It's a 5-year felony, as you know, and of course the statute, which has been determined to be 6 years because it is tax related. Ordinarily it's a 5-year statute of limitations. But this one is determined to be a 6-year, and it occurs from the last overt act committed during the conspiracy. So there are a few other charges on page 11. I will tell you right now, I can't, and I've been doing this a long time, I either prosecuted or defended any of those charges, but I wanted to put them on there just so that you know that there are a number of other charges potentially out there that just don't get much play. Okay, let's talk for a moment, if you'll take a look at page 12. There are a couple types of criminal tax investigations. Ones that are initiated at the agency level and ones that are grand jury investigations. Now, basically, on the administrative investigations, if you'll go to the next page for those who are watching, it's an agency-driven investigation, and there are multiple sources. The primary source for an agency-driven investigation would be a client who is under civil audit, who then, during the course of the civil audit, the IRS revenue agent, remember, the civil side, sees what they call badges of fraud that alert them that there might be criminal activity, that is, willfulness involved in the taxpayer's conduct. Those cases will then be referred to IRS CI, criminal investigation, which will make a determination of whether or not to conduct an investigation. All this is happening behind the scenes, and there are no there are no prosecutors involved at this stage. It's an IRS civil audit, a referral is made to CI. They're looking to see, okay, is there evidence of willfulness that raised this above just, oh, I made a mistake on my returns, I didn't know that I should have reported this, to I knew exactly what I was doing and I intentionally kept that off the return. They have other sources. I mean, obviously, just like any law enforcement agents, they might read investigative articles in newspapers, or they might have CIs or things like that. The tools they use are not dissimilar or not than ordinarily used. They'll have summons power at that stage, administrative summonses as opposed to grand jury subpoenas. They can get a search warrant. Search warrants have to be cleared through DOJ in Washington before they're permitted. They might use consensual monitoring or undercover operations, just like you'd see in a number of white-collar cases. The other source of the way these criminal cases get up to the prosecutors or to DOJ is that prosecutors will be doing it. You might have a case that involves, it's an anti-corruption case, dealing with bribes, or it's a fraud, healthcare fraud, securities fraud, what have you. And the prosecutor in that case might say, well, wait, there's a lot of income that was generated by this person's conduct, and I don't see it reported on the tax return. Remember what I said earlier, illegal income has to be reported. And so then they will use this as a way to get another resource into their case, a trained financial investigator, and also increase the potential penalties that your client might be facing. So it is not at all unusual that you will see what is called an expansion of a non-tax grand jury to include tax charges. The tools that they use are very similar, as we talked about. They can do search warrants, consensual monitoring. The grand jury subpoena obviously is a much more effective tool in a criminal investigation than an administrative summons. Those will be available to any AUSA or tax division prosecutors handling the case. Now, let's talk a little bit, because we only have a few minutes left, about the process that I've told you about, how these things have to come to Washington. So since DOJ Tax Division is required to either open the tax investigation or approve the prosecution, the indictment, you have an opportunity to request a conference with those people. And what you do is you send a formal letter to the DOJ Tax Division and you request such a conference. What you'll ordinarily receive in return is a letter that says, well, we don't have anything, but if and when such a referral is made to us, we'll contact you about scheduling a conference. So what's the purpose of the conference? Well, let me get down to the basics. What you will learn at such a conference is that here are the charges that the IRS agent and or the IRS agent and the AUSA are recommending. Here are the tax years at issue. Remember, each tax year stands on its own, or each tax period. And here's the estimated tax loss or tax deficiency, if you will. What they won't do is talk about any kind of plea. They won't talk about civilly settling those taxes and interest and penalties that are due, or compromise those tax liabilities. And you won't get any discovery from the government. So what's the purpose? Essentially, what this conference is designed to do is to allow you to come to the DOJ and present evidence as to why an indictment should not be returned against your client. If you're going to come to the conference and talk about things like, well, my client's ill, or something like that, I'm just telling you as a matter of practice, it's not going to work. If you have a more technical defense, it can be more effective. Now, from a practice point of view, again, we're talking, this is a 101 course, and I could spend a lot more time talking about maybe the things you want to do at a tax division conference. But there is, suffice it to say, that it's a judgment call by the defense lawyer. Do I want to expose a potential good argument that I have in the hope of getting this case declined in Washington so that they don't authorize the local AUSA to charge my client? Or do I hold it back and think it's something that's more appropriately raised in a jury trial? That's a very difficult call that requires a lot of judgment and experience, and also knowing who your opponent is, who are you talking to. So, as far as some of the other slides, I think you guys can read through them. I wanted to leave a little bit of time available so that there could be some questions either from the online audience or from people here. So let me do that right now. Shanna, any questions?
So Tom, we do have 3 questions. I'm going to give them to you from the hot seat.
Okay.
I'm going to start with the easy ones and work our way to the hardest ones.
Sure.
All right. A lawyer who will remain nameless has emailed me, and he says, I have had many clients who have willfully not filed tax returns, but none have been charged or even investigated under 7203. Is there a threshold for the IRS to pursue this charge?
Generally speaking, yes. They're never going to tell us what their threshold is, but a bottom line, you have to make enough money in order to have an obligation to file a return in the first place. Ballpark it, say $10,000. But look, we're probably talking about clients who are making substantially more than $10,000. So let's assume you have the obligation to file. Service is dealing with, literally, as I said, hundreds of millions of tax returns. And the fact that an individual is not necessarily picked up for an audit and then examined and then potentially referred for a 7203 willful failure to file is not that surprising. And if someone's been doing it for multiple years, sometimes it appears to me that they're off the radar screen. But the issue is, if they get picked up on the radar screen, these cases are not that difficult to make. And if you have multiple years, as I said when I referred to the Snipes case, you can stack those things, and if the person has not been making a good living and just hasn't filed for 10 years, they could be facing a substantial penalty in terms of jail time.
Is there a question from inside the room? No? I'm going to cite some case law.
Okay.
A case, Kuretsky versus CIR, refers to, I think, another case, Murray's Lessee versus Hoboken Land and Improv Company, where there is a due process standard that IRS may be held to, i.e. they are not the source of the standard, but they must adopt and comply with the standard that goes back to English law. How do you hold them to that standard in regards to the validity of an assessment on an individual?
Okay, I'm going to take a pass on that simply because when CIR is Commissioner of Internal Revenue, these are civil cases that we're talking about in terms of the due process that taxpayers have in making certain challenges on a civil basis. It's really kind of outside the focus of a criminal tax case. But maybe offline I could address that.
Okay, I'll share the contact info. Is the statement of charges made at a tax, I'm sure this person meant to write something I could read, but, I'm going to have to ask whoever just sent us a question to resend it, because I think they mistyped, and it's not a question that I can ask you. So in the meantime, I will ask you one of the hardest questions I bet you'll get all day. Regarding Al Capone,
Yes?
the investigation into him, how accurate was the movie The Untouchables?
I don't know. I mean, I wasn't there. I mean, I'm old, Shanna, but I'm not that old. But the general theory that, as you recall the movie, the accountant basically helped him make the case, helped Kevin Costner go get Robert De Niro. That general fact is true. That's the way they did approach it.
So because I'm an expert in iPhone typos, I'm guessing that this question meant to ask, is the statement of charges made at a tax conference limiting?
No, they won't hold that against you. So if you're an attorney and you go in there, generally speaking, the practice is we're not going to take that as a vicarious admission by your client, because otherwise, what's the purpose of having the conference if anything you say could be potentially used against the client? It's supposed to be more of an open discussion.
What about statements on behalf of the government? Can you limit them if they say, here's what we're looking at your client for, and then they start to pile on after the fact? Are they limited?
Well, let me answer that, Shanna, by saying this. They're usually not going to be talking to you at the conference. It really depends upon the individual that you have as the reviewing attorney. If they're a relatively new prosecutor, they're probably going to be very hesitant, because there's always this concern that we're going to work our magic on the criminal defense side and totally, submarine their case. So they'll be, look, I'm going to tell you what the proposed charges are and the years. I'm going to show you, I'll tell you that, but we're not going to talk. If you get a more senior person, they may engage you in that discussion, but ordinarily those kind of conferences are not going to lead to anything that really holds the government. Remember, they're in a supervisory capacity. The matter's being referred to Washington to seek approval, but the actual prosecutors handling the case might be in AUSA, say, pick a place, San Diego, New York, whatever. Oftentimes those AUSAs, if they have the budget, they might fly out and actually be in attendance, but they won't be speaking at it because it's their case. But the people at the DOJ tax, they're going to be reviewing it in a supervisory capacity, saying, look, do I look through the evidence that's been submitted and presented here and think that there is a reasonable probability of obtaining a conviction on this tax charge? That's their focus. By the way, why do they do that? You can't have a bunch of acquittals in tax cases, if you're the government, because we all voluntarily report our income and pay our taxes in this country. And so the whole idea is deterrence. So they're very careful in the way they select their cases, because they want to have what they consider a slam dunk case before they do it. Because when people get acquitted, and that's in the newspapers, then guess what? It's not that hard to think other people around the country might say, oh, you know what? I think I'll take a chance. And even if I do get caught, they didn't convict that person, maybe I have a chance, right? It just creates a roll the dice kind of situation.
So just for argument's sake, if you can get them to give you a statement of proposed charges, they do mention, here's what we're looking at your client for. Are they bound to that in any way? Is there any, I don't know if maybe
they're not bound to it.
It's just their initial thoughts.
They are not bound to it at all.
Okay.
They, oftentimes those are the charges that have been investigated. They might be able to use the same facts, gathered during that investigation to potentially bring another charge, but of course that would have to be approved at Main Justice as well. They're not bound to it, but all I'm saying is that as a practical matter, when a lot of time and effort's gone into putting together the case from the special agent's point of view and the AUSA's point of view, you're probably not going to see a lot of, oh, well, now I'm going to try something different here.
Regarding 7206, is there a limit to the good faith defense for preparers?
A limit. Good faith is always a defense in a You know, because when we talk about Cheek v. United States, which is, if you're interested in this area, something that you should look at, because it's not an objective standard, it's subjective. So if you subjectively hold the belief that I am not violating the law, that is a defense according to the U.S. Supreme Court. And so if you have that good faith belief, you know, regardless whether it's a taxpayer or someone who's assisting the taxpayer under, I assume they're talking about a 72062 charge, which is aiding and abetting a taxpayer in filing a false return, essentially, that will work, right? You have to show that it was an intentional, a voluntary intentional violation of a known legal duty.
Any questions from our live audience? All right, well, I want to thank everybody in attendance, and especially thank you, Tom.
Thank
Appreciate
you.
it.
Enjoyed it.